Hi, my name's Paul Sankey. I've been a top-ranked oil analyst on Wall Street for many, many years, and I send you a weekly video. Here I am. If you were following last week, I was in Granada, Spain, talking about the Alhambra and Arabic culture and the wonders of Spain having been ruled by Muslims for nearly 1,000 years. It's really an incredible story. This week, spot the palm tree. Am I in Marbella? Nope, I'm in Dubai. And back here, this place is an absolute phenomenon. You have the Atlantis, which, the Atlantis, which is a bigger version of the one they have in the Bahamas. And over there, the new Atlantis, where we had dinner the other night. Phenomenal dinner, great fish. Absolutely extraordinary. They've built a bigger one to start, and then they've built a bigger one. And that's the way Dubai works. And of course, here where we are is the Palm Jumeirah. And 20 years ago, I'd be standing in the sea right now. This is all new build. And as you can see, and the Hamptons always used to flip me out. It's just house after house after house. And I'm talking what was $600,000 houses in the global financial crisis. Now all of these are multi-million-dollar houses. It's quite remarkable. And totally peaceful, totally safe, actually perfect weather. Might get a bit lively in the summer here, but right now it's a joy to be here. Why am I here? The ADIPEC conference in Abu Dhabi next week, and next week what I'll do is I'll do the video where we talk about what happens at the big oil conference, which is, as they say, the CERA week of the Middle East. So CERA week is the big US conference where, you know, the powerhouses of global oil all meet to discuss things. The Middle East equivalent, which is obviously a big deal for oil and gas being in the Middle East, is the ADIPEC conference. And I'll be heading from here, Dubai, to Abu Dhabi, about 1.5 hours in an Uber on Monday. Okay, what happens in the past week? Well, XOM nailed it. And so if you subscribe to our research, which quite frankly is expensive, but if you can afford it, we did a very long note a few weeks ago on ExxonMobil, really praising the company for their long-term strategy. And what was really interesting about Exxon's long-term strategy that we covered in that note was that the company had it completely wrong in 2006. So we went back to 2006, and like everyone else, Exxon thought that the US would become increasingly oil import dependent. At the time, the US was already importing 13 million barrels a day of oil, and increasingly natural gas dependent, because we could all see that gas was the fuel of the future, basically because it burns cleaner. And what I don't like, and I keep saying, is this idea of fossil fuels puts coal with oil with natural gas, and they're not the same in terms of the way they burn. You have much less emissions from natural gas, and you need it if you want to stabilize a grid that's running a load of solar and a load of wind. As you know, those are intermittent energy sources, and so you need a base load that can ramp up quickly and shut down quickly to offset the natural cycle of wind and solar. And natural gas is clearly the solution. The other big solution is nuclear, and nuclear continues to be a mega theme that's developing really fast, and you've really got to get on top of US nuclear and global nuclear in order to understand how the energy transition is going to play out. And I'm really happy that this ultimately zero emission fuel is now coming back in terms of what had been developed post Second World War, and then of course through a series of accidents, Chernobyl, stuff like that, had become deeply unpopular. Nuclear, which has actually been a very safe, zero emission baseload energy supply, is now making a huge comeback, actually thanks to the incredible demands of AI energy, AI needing so much electricity that the big tech companies are now going all in with any sort of electricity they can get, particularly low emission, and nuclear is going to be huge. So stay on that theme. In terms of oil and gas, we had written this note, as I mentioned, about Exxon getting it completely wrong in 2006, and then still managing to rework their strategy and end up here, 2024, this past week, with great results because of their commitment to an absolutely consistent strategy of integration, scale, development of resource all the way through from hydrofracking in the Permian, deep water development in Guyana, all the way to the plastic that keeps your food fresh. And keep in mind that people talk about plastic bottles and, you know, the pollution from plastic, but don't forget that plastic packaging and wrapping has been absolutely vital to feeding the world. because if you don't have plastic and you don't use plastic, you're going to have even more egregious food waste than we already have. So don't always think of plastic as negative. Exxon is pretty much the biggest supplier of global plastics. And we need it to keep the world going, and we need it to keep the economic development going. Dubai claims to be getting towards net zero, but they kind of skip the fact that all these places are using cement, all these places are using steel, all these places are using plastics. So whilst their day-to-day emissions, like an EV, may be zero if they can get there, the reality of everyday life is you're going to need oil and gas, you're going to need a lot of steel and a lot of cement, and that's very energy intensive, and the best way to make that stuff is essentially going to be with natural gas. So the point I'm making ultimately about Exxon is they stuck with their strategy, they kept with their integration, and they were absolutely consistent through thick and thin. And in fact, the company has announced a further dividend increase, which makes the 42nd straight year that the company has increased the dividend. The ultimate value of a stock is the present value of the future dividends. Some people would say the present value of the future free cash flow. So it's essentially how much cash flow do you have versus how much capex do you spend, and how much of that do you return to shareholders. And to have 42 years of consistent dividend increases differentiates Exxon. It also differentiates Chevron. If you look at Shell, if you look at BP, if you look at Suncor in Canada, they all cut their dividends in 2020. Exxon, Chevron, Total all kept going with dividends, and that's hugely important for long-term investors. Additionally, with the integration that Exxon has pursued consistently, I think that's the Lamborghini. Actually, by the way, while I'm getting distracted, there was a parakeet in the, I was so thrilled, there was a parakeet in the palm up there, which, as you know from my video from Hyde Park, I'm like, why are there parakeets in Hyde Park? And I'm like, oh, a parakeet. Anyway, he's not there right now. Hopefully he'll come back before the end of this video. Sorry, I'm getting distracted. So on ExxonMobil, they absolutely delivered. You know, the stock is not expensive. I think it's a terrific long-term holding for any investor if you believe in continued economic development, continued population growth. And the key driver, again, of Dubai is low tax and rapid population growth. And we can really see where population growth is very easily. And it's the huge driver that is a real problem for China, a real strength for India, a real problem for Europe, a real strength for Africa. And you can see that's going to be the case for the next 20 years. So it's relatively easy to identify where the big global economic growth drivers will be over the next 20, 30 years, because the fact of the matter is today's population data tells us where we'll be in 20 years time, and you really want to follow that. So Exxon had great results. Chevron did well, but people were worried that they might miss because they've had some wobbly results over the past couple of years. They're still tangled up in trying to buy Hess. And so whilst Chevron performed better than Exxon on Friday when they also reported their results, it was more, I think, a relief rally than a real excitement about Chevron relative. And we still think that actually Chevron looks kind of expensive versus Exxon because of what Exxon is delivering, because Exxon's going to continue delivering these kind of results, in our view, right through the next 10 years. And we're going to get confirmation of that, in our view, at the December 11th analyst meeting, which is going to be a big deal. Chevron's doing, you know, okay, they delivered, they've got the big Kazakh development, but really the whole story is whether or not they can buy Hess, and that's not going to be decided in arbitration until 3Q next year. So it's a long time to wait for a key asset that Exxon obviously already owns, which is Guyana. So Exxon's got this Permian power story in the US, and then it's got this phenomenal story in Guyana, the fastest growing economy in the world. Makes Dubai look like a laggard, does Guyana. But of course, they're working off a population of under 1 million and a lot of oil. And the performance of the Exxon assets in Guyana is phenomenal. It's incredible what they're producing out there offshore. ConocoPhillips was good and BP was bad. Shell was good. But the key issue that we see here is that these big US oils, Exxon, Chevron, Conoco, are producing such great growth in the Permian that it becomes a problem for the oil market. So they're just growing and growing and growing at lower and lower prices. They've increased, for example, in the case of Conoco, their synergy targets. They're lowering their costs, they're increasing their production. And that effectively is lowering the real implied price of global oil. So it's a sort of paradoxical situation that these companies are doing so well that we have too much oil. And it'll be a challenge for Aramco, which is reporting this upcoming week, come back next week and I'll talk about that after I've done the ADIPEC conference. But essentially, there's too much oil, even at a time when oil demand globally is at all-time record highs. So is natural gas demand. So incredibly is coal demand. So demand for energy in this booming global economy remains incredibly strong, but through technology, through the application of better process, these big oils are delivering even more supply than there is really demand. And that's kind of a paradox of bearishness. Obviously, you want to be long the best companies if you're going to invest in that theme. And within that context, Exxon is clearly the winner. The loser, very clearly BP. You know, strategy lost their way, trying to pretend that they could become an energy transition company when they were not really a very good oil and gas company. Obviously, they have no credibility to deliver an energy transition strategy. Total, a great company, delivers great growth and has become the #1 global player in solar. So they've absolutely delivered. It can be done. BP can reinvent itself, but it's a big deal. And what we've been really critical of is that having had the previous CEO, Bernard Looney, fired for sexual misconduct, they put the CFO in as the CEO at a time when the board could have made a major change at BP, and they didn't do that. And the biggest call we've had this week, and the most interesting call, and the one that got most feedback from clients, is us calling for them to fire the board of BP. Let's hope that an activist comes in there and gets that thing sorted out, because it's a great British company that needs a great British strategy. And that's a tough one, because essentially the US, the European, well, the UK government is anti-oil and gas. So why would you be in the UK? Move the company to Houston, move the company to Dubai, do anything, but don't hang around in London screwing around pretending to be green, because no one's going to believe you anyway, and you're not going to do a good job of it if you do. All right, this is Paul Sankey. If we share ideas, we have more ideas. So like, comment, subscribe. God bless you.